Okay, welcome to week 9. So, before I start on today's material, we need to go back and finish off a couple of things from last week. So I stopped last week at, I introduced the multidimensional framework, okay? And I talked about where it comes from. Okay, so you saw the derivation. And there's nothing new there. It's just an extension of what you've seen already, but just applied to multi-dimensions. You still have this idea of a adjusted drift to each of the underlying assets. Really, the new part was this, okay, correlation. The correlation matrix, which is a number that tells your model how one asset moves relative to the other. Okay, so that's the new part. And that's what I want to talk about a little bit, because as magical as this result is, okay, the risk-neutral framework tells you can still work out the price of an option using an expectation. Okay, except now it's not a univariate expectation, it's a multidimensional expectation. You have many assets. Okay? So for instance, I think the example I mentioned, which I'll use shortly, which is the basket option. Okay, instead of an option on one stock, there are things in the market called best of call options. And these are basically options where you get S minus K, but S is the best performing stock. Okay? So even if some of the stocks go down, that's okay. As long as one of them performs, your option pays out. And that's where correlation comes in, because you need to co-model all of the underlying stocks. And I hope you've seen this already, Cholesky decomposition. It was probably covered in week 5 as part of the Monte Carlo lecture. But really all it's saying is that if you now need to compute a vector of correlated random variables, what are the correlated random variables? Well, we're working in terms of Z. Okay, so if two assets, S1 and S2 are correlated, that means Z1 and Z2 are correlated. So if we want to run a Monte Carlo simulation where Z1 and Z2 are correlated, then we need to be able to simulate correlated Gaussian random variables, right? And the Cholesky decomposition basically says you can achieve that using this identity. It's a transformation, okay? So the Z's here are, let's call it Z1, Z2, so on. And I'll use subscript perpendicular to emphasize that Z1, Z2, or Z1, Z2, Z2, however you want to call it, are uncorrelated. But somehow you multiplied by this matrix, and what you get out here are correlated Gaussian random variables. Okay? And this bit of linear algebra on the right is kind of the proof. Like, why does it work? And it works as long as you can achieve this decomposition, right? So you take your correlation matrix, which is D by D. Somehow, and there are algorithms to do this, you don't need to know about how you would actually do this decomposition, but assuming you could do the decomposition, you take that M, you plug it in here, and you get correlated Gaussian random variables. Okay? And in this course, this will always be fine. Okay? In this course, anytime you need to generate correlated random numbers, correlated Gaussian random numbers, that's good. What I want to make you aware of is that this is not a general result. It doesn't work in general for all types of random variables. Okay? Maybe that's the thing you need to be aware of. You need to appreciate the limitations of the mathematical tools that you're using. So although in this course, QF5209, this is always true, it's not in general. Okay? And does anybody know why this would not be true? Right? If you take a simple example of 1001, okay, this is the case of complete decorrelation. What you'd end up with here, Z1 and Z2, if you use that, you'd end up with Z1 and Z2 being two uncorrelated variables, right? In this case, Z1 is just Z1 perpendicular, Z2 is Z2 perpendicular. And by construction, these two are independent. And if you switch it to 1, 1, 0, 0, they're perfectly correlated. Okay? So it feels like this should be a general result, but it's not. Any guesses? What are we doing here, essentially, with this matrix multiplication? If you rewrite it, what this is doing is basically taking a linear combination of the independent Gaussian variables. Okay, it's just adding them up. Linear combination. So let's say you're in 2 dimensions, you take some value of Z1 and some value of Z2, add them up with some coefficients. Now the question you ask yourself is, say you had 2 Gaussian variables. If you add them up, what's the result? It is Gaussian. The sum of 2 Gaussian random variables is also Gaussian. But that's not an obvious result. Okay, it's not an obvious result. Why should the sum of 2 Gaussians be Gaussian? You can say that the sum of 2 Gaussians has a mean, which is the sum of the means. If they're independent, which they are in this case, you could say that the variance of the sum is the sum of the variances. But that doesn't mean the distribution is still Gaussian. Okay, now to show the result is beyond the scope of this course. You have to write down the characteristic functions, prove it in a different space, and then map back to your original space. It's way beyond the scope of this course. But that's really what the problem. Because you're taking a combination of random variables, the sum of those random variables might not obey the distribution of the original distribution. Take 2 uniform variables. Okay, let's say we have 2 uniform variables, U1, 1, and U2 distributed. Okay? Correlation is 0. And now I introduce a new variable, call it x, which is U1 plus U2. Okay? And the question is, what does x look like? Well, we know that x will be in the space 0, 2. Right? We can compute the mean of x. It's just 0.5 plus 0.5, 1. So it's kind of in the middle. That looks good. We can compute the variance. Again, linearity. But it turns out that x is not uniform. Okay? You could easily work it out. If you want to prove that something's uniform, then you need to show that something like this, some linear function of epsilon, right? And I'm not going to do the maths because we don't need to, but the sum of 2 uniforms is not uniform. Okay, which means that going back here, if you're dealing with some general random variable, independent, but from whatever distribution, and you add them up, you're not guaranteed that what you get on this side still obeys the same distribution. Okay? So that's the thing to be aware of. This thing works for the Gaussian case, doesn't work in general. Now, what do you do in general? That's also beyond the scope of this course, but I might as well lay it out for you. You go through something called copula functions. Okay? And the copula function tries to stitch together the codependence of the 2 independent random variables in a way that respects the original distribution. Okay? You will at some point probably come across copula functions, but not in this course. Okay, what I want to spend a bit more time talking about is just the dangers of correlation. Okay? Because it is one of the easiest to grasp concepts, but the most difficult to manage. Okay? If you're managing a portfolio, if you're trying to price an option, a lot of the disasters have been on the back of correlation. Okay? Correlation risk is a real and dangerous risk. Okay? Long-term capital management, which is one of the most well-known hedge funds, which spectacularly collapsed in the late 90s, collapsed because correlation risk. Okay? They misunderstood or maybe misjudged the size of correlation risk they have, and it caught them out. Okay? And these things happen all the time. In times of distress, correlation goes all over the place. So think about it. Think about what would happen. Say you're all in a banquet. Okay? Say it's the end of term, finish your exams, you're all in a banquet. It's a big party, everybody's celebrating. Okay? You have people on the dance floor, you have people drinking, they're there for the free booze. But some people who just want the free food. You've got people who are mingling, maybe trying to meet their future partner. It's a diverse crowd, right? Everyone's doing their own thing. But what do you think would happen the moment the fire alarm went off? What would happen? Everybody's exiting, right? The moment the fire alarm goes off, everybody's heading for the door. Doesn't matter what you're doing, even if you were a little bit drunk, something in your brain will trigger and you're running for the exits. Doesn't matter who you're talking to, you're climbing over them, you're heading for the exits, you're leaving them behind. You're out of here. The point is that in times of distress, all correlations go to 1, right? Or -1. People start behaving the same. Any diversification you have is gone. And that's the problem with correlation risk. Okay? That's the big, big problem. It's not easy to predict. Okay? You don't know when the correlation is going to happen, when it's all going to converge to 1. You certainly can't hedge it. Okay? We haven't seen anything at the moment to show us how we would hedge correlation. We've talked about hedging the underlying asset, but that's about it. And related to the second point, which is that it can change dramatically. Okay? And why this matters is, let's take a simple case of a basket option, the best of call option. Okay? You buy an option on one underlying stock. If the stock price goes above a strike, you get your payoff. If it doesn't, no payoff. But let's say you're talking about a best of option on 2 stocks. And let's say both stocks are at $100 today. Okay? And your payoff is the best performing stock at expiry. The payoff is best performing stock minus 100. Okay, that's your payoff. And what if now think about the correlation. What if the correlation of the 2 stocks is pretty close to 1? Maybe they're both tech stocks, both behave the same way. They both start off at 100, they both move together. You can imagine that when they rally, they both rally together. If they sell off, they both sell off together. Let's say 50% of the time you go above the strike, you get a payoff. 50% of the time, below the strike, no payoff. Right? If the correlation is 1. What if the correlation is negative? -1. 2 questions. Do you think that will change the value of the option? Well, yes, otherwise we wouldn't be talking about it. Second question is, does it make the option more valuable or less valuable? Who thinks more valuable? Nods don't count. You've got to put your hand up. Who thinks less valuable? Okay. Well, let's think through it, right? What happens now? First stock price goes up. What's happening to the second? Second one's going down, right? Do you get a payoff? Yes, because you only care about one of them going up. It doesn't matter which one. What if the first one goes down? and the second one goes up, you still get a payoff. Okay, so your payoff's gone from 50% to 100% because the correlation's changed. Okay, so the correlation can really change the value of the option. That's why it's an important parameter. Okay, because we'll see later today, the price that you sell an option at, that's really everything. If you get that wrong, your business is done as an investment bank, as an option trading desk on an investment bank. If you get the price wrong, it's game over. Okay, and we'll talk about that in quite a bit towards the latter part of this today's lecture. But here's an article from 2009. The 2009 financial crisis was a crisis caused by correlation. Okay, this is, I can't remember which magazine it was in. Incidentally, that formula up there is the Coppola formula. Okay, you don't need to know it for this course. But this is an article that says basically this formula, which is indirectly saying correlation, caused the 2008-2009 financial crisis. And it's true. Models played a big part in the 2009 crisis. Do we have time? All right, let's make time. What I'm about to go through is not material for this course. You will not be assessed on it, but I want to give you some perspective. Let's talk about a regular commercial bank, right? Not an investment bank, regular commercial bank. How do commercial banks work? How does a bank make money? How do we all interact with banks? Okay, deposits. We're all savers. We had $100. We give it to the bank for safekeeping. Okay, the bank tries to entice us by giving us some. Well, what do they give us back? Interest, right? 2%, let's say. I'm making up these numbers. Okay, where does the bank get the 2% to pay us as savers? Right, as loans. So on the other side, something else is going on. So the two parties that interact with the bank are borrowers and savers, right? So we have the savers, and these are borrowers, need to borrow for a mortgage, say, or to start a business, whatever. And they always pay a higher rate of interest. Okay? And that's it. That's really, in a nutshell, the banking model, the banking business model. Lenders and savers. The bank sits on a nice 3% profit, assuming everything goes well. Okay? Now, if this was the end of the story, it'd be a bit boring, but a bank probably wouldn't sustain itself on 3%. What the bank actually does is it tries to recycle these loans. Okay? So something you may have come across, the term is of an asset-backed security or a mortgage-backed security. Okay, that's what I'm going to introduce now. So you have these new investors. And they don't want to pay, they're investors. They're looking to maximize returns. They don't want 2%. It's too low for them. Okay? So the bank approaches these investors and says, okay, I've got an asset that you can purchase off me, a bond. Okay? You give me your $100, and I will pay you 4% interest. Okay? Much better than the 2% you'd get as a regular saver. I'm going to pay you 4%. And how do they do this? Is they basically reroute these interest payments that way. Okay? And they get the $100 back. So they're back to square one. Okay, the bank's back to square one. They've got their $100 back. These, let's say, homeowners, mortgage holders, are paying 4% there. 1% stays with the bank. And the bank does this whole thing again. Okay? So under the pure green cash flows, the bank was making 3%. Now it's making 3. If you follow it through, there's an additional 1%. So the bank makes 4%. Okay? What they've done is basically sold the loan off to other investors. Okay, so far so good. In practice, they're not able to sell the entire lot. Okay? The bank ends up being an investor. Let's call this a mortgage-backed security. They don't sell all of it. They end up keeping a bit of it, right? They're investors in the mortgage-backed security. But that's basically it. Now, what are these investors thinking? What are they concerned about? They're concerned about losing their money, right? They want to know that this mortgage-backed security, which is a bond, is safe. That if they invest in it, they minimize their risk, right? And the reason they have this confidence is because the bank is able to tell them that these bonds, these mortgage-backed securities, are actually AAA rated. You know, the rating agencies all agree. And if you think about the maths a little bit, you might agree. Because what's the risk for these guys? Let's take the extreme case. Let's take the case that the investors get totally wiped out. They lose all their money. And let's say, for the sake of argument, this came from 100 people, okay? Each borrowing $1. Doesn't matter. Okay, so what's the risk? What's the risk of total wipeout? Because remember, these investors get their coupon because it's been rerouted from the mortgage holders. Okay? So the risk of total wipeout is, let's call it 10%, is the risk of one mortgage holder defaulting. Okay? Bad things happen. You lose your job, medical reasons, whatever. Okay? Can happen. What's the risk of all of them, all 100? Pretty zero. Well, it depends, but you think if somebody has a bit of bad luck, medical condition, it doesn't affect their neighbor, right? Their neighbor's probably okay. So you can make an approximation that they're all independent. The risk of total wipeout is what, 100? 1 over 10 to the power of 100, right? Which is 0, right? It's tiny, insignificant. Okay, so when times are good, this is all working fine. The correlation was 0, okay? Now what happens when there's a recession? And these recessions come up all the time, right? It's a normal part of the economic cycle. During a recession, people start losing their jobs. Businesses start to close. People start panicking, laying off workers. Everybody's worried about their own business. Now, if somebody loses their job, there's a good chance that their neighbor has lost their job. They're probably working at the same factory, right? So what happens to this probability? To the power of perfect correlation. 1. Okay, there's no diversification. If one person's lost their job, it means everybody's losing their job. Okay, I'm vastly oversimplifying. I just want to get the idea across. But you've gone from pretty much 0% risk to 10% risk. You try telling these investors that they got to put up $100, but there's a 1 in 10 chance back, they're not get anything, right? All for a measly 4%. They'll say thank you, but no thank you, right? It's not going to work. As soon as they see it happening, they start selling these bonds like there's no tomorrow. They don't want it. They want out. The price of the bonds go down, crash. The bank was an investor in those bonds. So they've got holdings in the bonds that are losing money. In fact, the banks are the biggest investor because they've done this so many times that every time they keep a little sleeve, it adds up, right? So they're sitting on massive losses. If you're a saver at the bank, what are you worried about? You're worried about your money. Okay? You don't want to save your money in a bank that might go bust. It's going to take your money with it. So these guys are all withdrawing their money. precisely at the time when the bank needs it the most. Okay? So these guys are unhappy. Banks losing money. Banks losing its funding. This whole cycle, which keeps the economy going, just stops. Okay? Never mind these savers, other banks who lend to each other on a daily basis, it's just part of the normal operation of the markets, it all stops. And that's what they call the credit crunch, because it just ground to a halt. It just stopped. Nobody wanted to take on loans. Nobody wanted to make loans. Nobody knew how bad the situation was. For some banks, it turned out they weren't so bad, badly affected. For others, like Lehman, they went down. Okay? All because correlation went from kind of diversified, and it switched over a very short period of time to pretty much one. Okay? So sorry, it's a bit of a digression, but I think just to keep in your mind the risk of correlation. Okay? It's really a parameter you can't hedge. It's a parameter you have to be a bit careful of, and you can't offload the risk. Not too dissimilar. Not too dissimilar. We've already seen a parameter that's like that. Go back to standard Black-Scholes. The volatility parameter. It's a key parameter in Black-Scholes. What did we do? We just assumed it's some value. And we assumed we knew it. And we assumed it would never change. Okay? But it could happen. Volatility could suddenly skyrocket. And it happens all the time. Times of distress. Okay, we'll talk about that a little bit when I do the demo. But the thing is, with volatility, there's a way out. You can adjust for volatility. You can come up with a better model. We don't have something to do the same with correlation. All right, any questions? Okay, we'll move on to today's material. So really a continuation of Black-Scholes. We've seen the formula. You've all derived it. I hope you all had a chance to derive the put option for yourselves. As I mentioned, it's a worthwhile exercise for you to make sure you understand the techniques that get applied. Kirsanov's theorem, the expectation. And as I mentioned, it's very easily a question that could come up on an exam. Okay? You could be asked to solve a pricing or to come up with a pricing formula, which will use a lot of the similar techniques. Okay? So if you're comfortable with it, you can easily adapt it to the nuances of a different problem. Okay? So it's worth doing. But we're going to talk about the Greeks, which are an extension to kind of the Black-Scholes framework. Sorry, extension is the wrong word. It takes the usage of Black-Scholes further. Okay, so today we're going to think about Black-Scholes not as a model, not as a quant, but as a trader. Okay, that's where all these Greeks come in. And I'll do a hedge simulation, a demo, up on screen to show you how it all works. Because you've seen the maths, you've seen the models, you've solved them. We've emphasized to you this idea of replication, self-financing, but today you'll see it. You'll see it in action. So that even if you see the maths, but you're not quite convinced, seeing it in action just kind of proves to you that it works. Okay. And then we're kind of setting the scene for next week. Okay, which is implied volatility. I'll introduce the concept of implied volatility, but next week's a big topic in terms of how we depart from Black-Scholes. Okay, so Black-Scholes says volatility is constant, deterministic. We move away from that. Okay, so that we don't get some of the disasters that we know can come up. And lastly, I'll introduce this equation. Any physicists in the house? Actually, I know we have one at least. You may have seen this already. We will use it a little bit next week. It'll come up. But really, for the purposes of this course, you won't be assessed on this. We've done so much maths that this is a tiny step. You know, you might as well take it. I might as well give you the result. Okay? All right. That's the famous equation, pricing formula, Black-Scholes call option. Now, here's the thing. We need to distinguish between variables, and parameters. Okay? The pricing formula, if you look at it, I mean, every symbol on there is a number. Okay? But not all numbers are the same. Some of them are variables and some of them are parameters. Okay? You need to be able to understand the difference. What are the variables? These are the variables. V is really just a function of time and S, right? Even though you've got a lot of different symbols there, the variables are time and S. That's all the Black-Scholes or the model assumed can change. Time ticks forward. S moves but randomly, but they're both variables. Sigma and R are parameters. Actually, they're more specifically model parameters. Okay? They're parameters which lock down a particular case that you're looking at. Okay? Once you lock down volatility, you're talking about a particular asset that behaves a certain way. Right? You can change it, but then you're looking at a different problem. You're looking at a different asset. Okay? Interest rates are also locked down. We assume they're constant. When I say constant, I mean they can be deterministic, but we can integrate that away. Okay, that's the point I made last week. It can change deterministically, but then the point is that it can't change to a different deterministic function. Once you pick a functional form, whether it's constant, you've got to stick to it throughout the whole Black-Scholes derivation. Okay? R is the same, interest rate. If you change interest rate, you're talking about a different economy. Okay? And then you notice that there's also K, T. They don't really fit anywhere. I would call them trade parameters. Okay? They lock down a particular derivative. If you're talking about a call option with 1 year expiry, strike 100, that's one call option. It wouldn't have made sense to change K from 100 to 120 halfway through the life of the trade, right? That doesn't make sense. Or you can't change T from 1 year to 5 years halfway through the life of the trade. These are trade parameters, they're fixed. In a similar sense, from a modeling perspective, you can't change sigma and R. If you do, bad things happen. Okay? So parameters, trade parameters, model parameters, variables. So really there are only two variables. And you have a function of two variables. And the great thing about a function is that once you identify the numbers that go in, you know what comes out. Okay? And V is essentially the price, the value of the derivative that you're holding as an investor. So if you're an investor in this derivative, what do you want to know? Well, how much could it change from today to tomorrow? Okay? And if you have a formula, you can apply Taylor expansion. That's all we do. Okay? Delta T over 1 day. If S changes by some amount, now S is random, so you can't predict this, but the point is that once S does change, you know how much your derivative has changed in accordance. Okay? And this is the term we kept because of the Ito term. And I'm going to ignore the higher order terms. They're there, but I'm going to ignore them. Note, I did not include dV by d sigma. I didn't include dV by dr. If I told you I didn't include dV by dk, maybe that's kind of obvious, right? Why would you? But really, it turns out these are not too different, right? Putting those in would be very similar to adding that term in. It just doesn't make sense. You've changed your problem somehow. And really the terms are theta, delta, gamma. Okay, so we're just going to go through them one by one. Any questions so far? All good? Okay. So first question is, you're an investor in the derivative, it's got some value, you care about how much that value changes from one day to the next. First question is, if there are no moves in the market, okay, value of the underlying stock doesn't change from today to tomorrow, what happens? Okay, so what happens if nothing happens? Well, something's always happening, right? Time's ticking. You can't stop that. So whatever happens, the theta term, which is the dv by dt partial derivative, that's always going to come into play. Okay? And I think we spoke about it last week. You remember here, the dotted line was the payoff. The orange line was the value at some time before the payoff. And what did we say about those two functions? As you approach expiry, the orange line morphs into the dotted line, right? Has to. So value, if you're there today, what's going to happen to it? It's going to go down. Okay, you're along a vertical here. So the stock price isn't changing, but as time goes by, you're morphing downwards. Okay, so that's a hint. Theta in this case is negative. You're going to lose money from one day to the next. Okay, and the reason you lose money is because of this idea that we also talked about briefly last week, intrinsic versus time value. Okay, intrinsic value being, let's say we're here, the intrinsic value is just the value of the payoff. The time value is the difference between the payoff and your true option price. Okay, and we have this time value because, well, you still have some time. Stock price might go up even more in your favor. Okay, it can also go down, but the point is that your downside risks are all floored. Okay, so that's what the time value is. Okay, so let's try to unpack theta a little bit, try to understand it. And the technique that I'm going to use here is very useful, not only for the purposes of exams and understanding how to draw these profiles, but also to get a very intuitive sense of what's going on if you're looking at a derivative. Okay, so let's stick for the rest of today to call options, European call options. And let's say I'm talking about the theta. Let's do S first. Okay. Remember, there are only two variables. There's S and T. So here I'm freezing T. I'm saying, well, how does the theta look as you vary S? Which is nothing more than asking what's happening across this spectrum. Okay. Let's take the example here. Stock price, strike price at 100. Okay. Let's say the stock price is way down here, 20. It's a call option. And the theta is how much the value of that option changes from one day to the next. Okay. So if I own this option, strike price is at 100, and the stock price today is 20, am I going to change my view from today to tomorrow? Does anything really change? What really changes today to tomorrow? Strike price is so far away, probably nothing, right? I mean, that's what this is telling us. Orange line is already on the dotted line, so the theta is pretty much zero. Same on that side. If you're deep in the money, okay, now let's say the strike price is 100, but the stock price is at 200. Does anything change from today to tomorrow? Not so much, right? You're pretty much guaranteed the payoff. Over the long term, things could change, but over one day, not much is likely to change. Okay? What really happens is all around here. Okay? What really happens is all around here. That's where the gap is the most. And we know that the two lines have to merge. Okay, so the theta looks something like this, very approximately. That's what you'd expect. No theta for deep out of the money, deep in the money options. But if you're close to the strike, then theta comes into play. Okay, what about the other dimension? And I'm going to call it capital T instead of little t, right? It doesn't matter. Question is, what does theta look like as you change the time to expiry? So let's break it down. Let's think about a deep in the money option. Okay, deep in the money option. Strike price 100, stock price 200. If this option expires in 5 years, what changes from one day to the next? Stock price can move a little bit, but is it going to change the global picture of things? Not really, right? You're still going to be holding something that's around, stock price is around 200, strike price is still at 100. The option's still going to be pretty valuable, okay? So passage of one day doesn't really change much. And you can make the same argument on the other side, okay? If you've got an option which expires tomorrow, stock price is 200, and the strike price is at 100, you're as good as done, right? It's going to expire in the money tomorrow. So you're here as well. But what you get is something like this. Somewhere in the middle, no matter how deep in or out of the money you are, there's a level where the two kind of offset, where you care about one day passing. Okay? So this is a deep in the money, out of the money option. Which leaves the other one, at the money. Okay? Let's say we're at the money. Strike 100, stock price at 100. 5 years to expiry. Kind of feels like at the moment it's a 50-50. If you're at 100, may go up, may go down. Are you going to feel much differently tomorrow? Still 50-50 tomorrow, right? And you've still got a whole load of time for things to change. The point is, from one day to the next, nothing's going to happen. What about this side? Now you've got a option expiring tomorrow. Strike at 100, stock price is at 100. Do you care about that day? It feels like you do, right? As things stand, the option is worthless, but it could easily move in your favor. Right? It could go against you, but, well, you're already at zero, so you don't care. So you have that time value. Okay? You're really at this point here. So what you end up with is something that goes like that. Okay? Maybe exaggerated, but with 1 day left to expiry, you're going to lose all that option value tomorrow. Okay? If your option price is a few dollars today, you're going to go from whatever it is to zero tomorrow, right? Because you're at the money. And if you expire at the money, you get zero. Okay? Is that clear for everyone? That's theta. Let's talk about probably the most important one, delta. It's the first derivative with respect to s. Okay, so we've done the first. We've done time. We're going to do s. And how do you come up with that expression? Actually, I could have said the same question about theta. Like where does the number come from, right? And there are two ways of doing it. Something called analytic or bumping. Analytic just means you've got a formula for it. And as I mentioned last week, anytime you can come up with a closed form formula, that's what you want to do. Okay, it's fast, it's accurate, it's easy to plug into a computer, no problem. So anytime you can, use analytic. And for Black-Scholes, it turns out theta has an analytic expression. Delta also has an analytic expression. The derivations are very, very messy. So I would not expect you to be able to do it for an exam, certainly. But you would be expected to reason about the behavior based on these diagrams that we've been drawing. And we'll draw a few more. Okay, so if you can do it analytically, great. What if you don't have an analytic expression? When would you not have an analytic expression for any of the Greeks? Yeah, if it's unsmooth. Something. Not really. How do you rationalize? I mean, the whole thing is in the future, right? The payoff is in the future, and yet we came up with a price. The stock price is stochastic. You don't know what it's going to be in the future, yet we came up with a price. Okay? It's maybe a more mathematical question. When is computing that guy not possible in closed form? Well, how about if you don't even have V in closed form? Okay? If you don't have V in closed form, you're definitely not going to be able to get dV by ds in closed form. And when do you not have V in closed form?
It's American.
Yeah, but also if it's any Monte Carlo, if it's any binomial tree, which you couldn't work out analytically, right? Because it's American. If it's on a PD, so any of the numerical techniques we've looked at, straight away, you can't figure out what dV by ds is. There's no such thing. Okay, I'd be very impressed if you could figure out the closed form for the derivative, but you couldn't even do it for the actual price. Okay, so very often you have to resort to this other thing called bumping. Bumping is also bump and reval, many different names. All it is use finite differences. Okay, you've seen finite differences. You've seen in the PDE lecture how you can approximate the value of derivatives using finite differences on a grid. Right? F up minus F down divided by 2, something like that, right? You've got one-sided finite differences, which were order delta squared accuracy, central order delta cube, if I remember correctly. So that's what you do. That's what bumping is. Okay, that's the maths. What does it actually mean? Okay, why do we care about delta? And there are these two kind of players in the market. The investors, think about hedge funds, the buy side, and the banks, sell side. And they both deal with derivatives, but their philosophy with delta is very, very different. Okay? For an investor, they're asking the obvious question. What is the exposure of my portfolio to moves in the underlying? Okay, I've taken risk. I've bought Amazon stock. Maybe I've gone long through the derivative. What I want to know is, if Amazon moves by 1%, what is the value of my portfolio? That's it. Okay? V could be some portfolio of options. Okay? But you can apply linearity. The delta of the portfolio is just the sum of the individual deltas. Okay? That's the investor mentality. The banking or dealer mentality is very, very different. Where the hedge funds are hungry for risk, and they're trying to understand how much risk they've got, and that's what delta tells them, the banks think of it as, how much risk do I need to eliminate? Okay? Because banks, maybe it's a little bit surprising, are not in the business of taking risk. Okay? Banks actually don't want to take risks. It's very contradictory to what you see on TV and movies, where big trading floors and they're all waiting for numbers to come out, and that's not the banking model. Banks are trying to get out of risk. And we're going to see this in a lot of detail in a few slides. But essentially, the banks and the dealers, they think of delta and they think, well, how much do I need to hold? Remember when you did the derivation, we said delta to eliminate the risk and make the portfolio risk-free. You had to enter some units delta of the underlying stock. There was a minus sign because you needed to sell. Well, that's that delta. Okay, that's how the banks think of it. Okay, we'll come back to that. So that's the expression for a call option. Okay, again, it sounds like it should be very simple. Okay, if I go back to the formula here, and you want to take dc by ds, and you're left with this term here, it feels like, okay, it's not so bad. Just dv by ds goes away. But d1 and d2 are also functions of s, right? So if you wanted to do this properly, you apply the chain rule, you take derivatives, you change them together. I've never done it myself. Magically, they all disappear, right? And you're just left with D1. Okay? You don't need to do the derivation for this course. It's just the maths is too messy, and I don't see the value. What you do need to know is what are the kind of limits. Okay, call option. Okay, so we can take two obvious limits. What happens as s goes to infinity, and what happens as s goes to 0. Okay? And we just do the maths now. As s goes to infinity, what do we get? Well, all these are constants here. These are all constants. S goes to infinity, so the log of infinity is infinity, right? It goes to infinity slowly, but it goes to infinity. So D1 goes to infinity. Anybody remember what that is, that symbol? Cumulative function of the Gaussian, right? So it's the probability of of z being less than or equal to D1. And as d goes to infinity, that goes to 1. So delta goes to 1 as z goes to infinity, which makes sense because from payoff diagram perspective, as you've seen, it goes to 1, right? That slope, which we said is delta, tends to 1 as s tends to infinity. So the maths agrees. And s goes to 0, you expect the derivative to go to 0. Okay? And it's not too difficult to see because I've given you all the clues, but as s goes to 0, what happens to the log at 0? Minus infinity, right? So d1 goes to minus infinity. The cumulative distribution function at minus infinity is 0. Okay, so it all just works out. So delta is always, for the call option, between 0 and 1. Okay? And very, very loosely, you can think of delta as being the probability of expiring in the money. Very loosely. Because think about the call option again. If s goes to infinity, yeah, you're probably going to expire in the money. If it goes to 0, you're probably going to expire out of the money. I put it in quotes because it's approximate. It's not true. And you can actually tell me why it's not true. Okay? It's not exactly psi of d1. You saw what it was when we did the derivation last week. There was a term which measured the probability of expiring, of being beyond k. That was the second term of the derivation. And that looked something like psi of, or it was psi of d2. And the only difference between d1 and d2 is this sigma term, right? So that's why this is approximate. It's usually pretty good, good enough for kind of big picture analysis. But if you wanted the real answer, well, you've got that too. It's actually psi of d2. Okay? But delta being between 0 and 1 in these extreme cases, that's also important. We'll see that in the demo. Okay? Right, so how would you kind of get a visual representation of delta? This, you're probably bored of seeing this chart already. That's the payoff, that's the value. Delta is nothing more than the derivative of the orange line. Agreed? It's dv by ds. It's 0 here, and it's 1 there. We've seen that already. And then it kind of just curves upwards, right? It slowly increases. So you get dv by ds. Maybe more interesting. So let's say this was an option that expires in 6 months. Okay? How does it change? How does the picture on both sides change if I now tell you compare the diagram or plot on there the profile for an option that expires in 3 months? Okay? So original one is 6 months, 3 months. What do you think happens? Okay. This one kind of goes down, right? So this discontinuity It's only really discontinuity at expiry, but it gets a bit more pronounced. Okay, so you get something like this. It definitely does not go below 0. And what happens to that one? Well, if you think through it, the derivative here goes higher. So you end up with something maybe like that. Okay? So t goes from 6 months to 3 months, for example. Okay? Okay, let's take a short break there. Come back in 10 minutes, so 5 past, and then we'll talk about gamma, and then I want to go through the demo, the whole banking model. Okay, we'll come back in 10 minutes. Okay, let's talk about gamma. So delta, as I mentioned, is probably the single most important parameter. It's the one that investors or traders care about the most. It's like the first order risk. In fact, it's so important that they want to know how it can change. Okay, what can cause it to change? And gamma is just the second order derivative with respect to S. So it's another way of thinking of it is exactly how does delta change when the underlying price changes. Okay? And to compute it, once again, if you can come up with an analytic expression, that's what you do. If you need to use finite differences, then you know the formula for computing the finite difference approximation to the second order derivative. Okay, you need 3 points now, one on each side plus the point in the middle. You should be able to, by the way, derive those finite difference expressions, right? Derive rather than memorize. It's a whole lot easier to just derive them rather than try to memorize them and get a sign wrong somewhere. It's just Taylor expansion, take differences. If you do it that way, you also know the error, right? The convergence error. So that's another approach. The third one that people also use is spline fitting, which is nothing more than just computing the price at a few points and then fitting a curve and then taking the second derivative of that curve. Okay, that's another approach. But what does it mean economically? Or first, maybe we should talk about how it changes. Okay, if we want to include now the gamma. Well, what's the gamma? It's basically the first order derivative of delta, so it's the derivative of this line. Okay? And we've done this a few times now, so if I draw gamma, what's it here? 0, right? The derivative of the orange line is 0. It's 0 here as well, because that line flattens. Notice that it's always positive. Okay, it's always positive. And the gradient is kind of highest in the middle somewhere. So what you kind of expect and what you do get is something that looks like that. Okay. Right? Just very broadly. And that's what we've got here. That's the profile. By the way, I'm doing all of this for call options. Okay? The case for put options, very similar. Okay? And in fact, it's even easier than you think because you don't have to think about it for the put option. If you know it for the call option, you can get it for the put option by a very simple relationship. We'll come back to that. But in terms of gamma, so now the question is, from the banker's perspective, remember the banks wanted to hedge this. Okay? They need that term to stay 0 because that's their business model. Gamma can take them away from that. Okay? So they need to understand how gamma can deliver them into a delta that they want to keep at 0. That's one implication. The other one is that remember in the derivation what we said about that term? We said it's all Ito calculus. This thing is basically a dt term. And we proceeded. It's not, right? It's dt in the limit of infinitesimal time. One day to the next, delta s is random. Delta s squared is still random. Okay? And really, gamma's challenging or measuring how good that really is, or how important it is. Hope you see. If gamma is 0, you don't care. Okay? You don't care whether delta s squared is random or not. It's 0. So it's kind of measuring, in some sense, a breakdown of Ito's lemma, in a practical sense. But more importantly, it's really measuring how is your hedging strategy changing from day to day, right? Because you want to keep it at 0. You want to keep the delta at 0. And kind of if you remember this, this is basically Black-Scholes the Black-Scholes PD, but rearranged in a sense. And it said that the theta plus the gamma is this very controlled thing. Okay, it's dt. There's no randomness. You may not know what it is, but it's just where you are today multiplied by dt. Okay, so you tend to see, and it's easier to see on the diagrams, but this equation is basically saying the same thing, is that there's kind of an opposing relationship between theta and gamma. Okay, if theta is doing something crazy, negative, chances are gamma has to be doing something equally crazy, positive, to keep this all under control. Okay, that came from the derivation. And on a practical note, theoretically, it says that they offset each other very, very neatly, and you get this nice, neat dt term. On a practical level, well, you have to ask the question, well, which one's going to win? Right? Is theta going to win? Is gamma going to win? Okay, so there's kind of this offset between the two that you need to think about. And you'll see it a bit clearer when we draw the payoff diagram. When we draw the gamma diagram for the digital option, which I'm going to use as a case study. Okay, so that's the banking model. What about the hedge funds? Okay, so these guys want to keep the risk. They're kind of almost the opposite. They want to keep the risk. They're almost asking the opposite question. Is gamma taking me away from my risk? Okay. Is it eating up into my delta? Or is it giving me more risk than I actually realize I have? It's equally dangerous situation, right? Where you think you want to have a certain position, turns out it's double the size because gamma is giving you that extra pickup, and that's way more than your appetite, right? What you've agreed with your investors is X. You turn around tomorrow and say, actually, it's 2X. It's not going to go down well. Okay? And gamma can cause that to happen. Okay, so how can the position change? And now we can ask another question, because we've seen the Greeks, you've seen delta, you've seen theta, you've seen gamma. Now if you're an investor, you can be a bit more sophisticated in terms of how you make decisions on what investments you make. Say the investment you make is you want to take a short position in the stock. You think tech's overvalued, it's all going down. Okay, of course you can sell the stock, but the point is that that's not leveraged. You want to do it through options. So a thing you could do is buy a put option, right? It's exactly what a put option does. The payoff of a put option is something like that, right? Price goes down, you make money. But you could also do it by selling a call option. Okay, what does selling a call option look like? It's that. Okay, it's negative of a long call option. So once again, if you're going that way, you're making money, right? And which one would you choose? Up until now, maybe you'd be indifferent to it. But now you can look at each of these two strategies, look at the other Greeks, look at the theta, look at the gamma, and you'll see they're very different. Okay? Put option, positive theta, negative gamma. Sorry, put option, negative theta, long gamma. Sell a call option, positive theta, negative gamma. Complete mirror images of each other. Okay? So you decide, what do you want to do? Are you worried about gamma? Or are you more worried about theta? And you make your choice accordingly. It's the same strategy, right? You get to the end result all the same, but the journey there is different because one of them is positive gamma, one of them is negative gamma. Okay, so that's how the investors will think about it. Now, a couple of other, I even hesitate to call these Greeks, but textbooks will. And they do this because Black-Scholes is just a formula. And it's filled with symbols, and each of the symbols have a number, and the number can change. So you want to know how much will the value of my derivative change if that number changes. So interest rates can change, right? Nothing's stopping you. There's no rule that says interest rates can't change. It's just a model-imposed restriction that we made. Because back on day one, we said a model is just our representation of the world. And in this simplified representation, we said, we're going to assume R doesn't change. Come up with a formula, there's nothing stopping you abusing that model and saying, well, I'm going to change R. If you decide to do that, rho measures that impact. Okay? You could do the same with Vega. The derivative with respect to sigma. You could do that. Now what we're going to do next week, maybe it's not obvious to you at the moment, although that's a number you can compute, okay? And although it's a number that would make sense, it's a number that has no role in the model, okay? Because the model, think about how the genesis of the model. It assumed constant volatility. Okay? If you go ahead and change that, you're kind of abusing something in the model. If you change R, you're abusing something in the model. It was never a variable. It was a parameter. What we're going to do next week is we're going to take sigma, we're going to make it a variable. Okay? Once you do that, this is valid. You can start talking about Vega. Okay? Later on in the course, maybe week 12, week 13, and we're just going to touch on this subject. We're going to take R and make it a parameter, make it a variable. Okay? What we're really saying is we're going to make volatility stochastic in addition to S being stochastic. We're going to take interest rate and make it stochastic. Okay? But at the moment, they're all just parameterizations of the model. They're given values, and that's it. All right? So sigma changes. If that changes, what we're saying is that, Black-Scholes is just a model. That model is a log normal distribution for S. Sigma changes means that it's still log normal, but actually it's wider or narrower. Right? What you said on day one is no longer valid. You've changed your mind. Next week, when we introduce stochastic volatility, we're going to say that actually, what if the log normal distribution itself is not valid? Right? And I don't want to go through it, but that's the Vega profile. And maybe this is a little bit important because it's going to come into play shortly. The thing you need to think about with these parameters changing value is that they're going to cause a step change, a discontinuity in your function. Okay? They're going to cause a discontinuity somewhere because you sell an option today for 1 year expiry. Even though you do the trade today, it's not over. It's not over for another year. It's only over when the option expires. If between now and option expiry you change things like interest rate, you change things like volatility, you're breaking something somewhere, right? And it manifests itself like a discontinuity. And this function is nothing more than someone's worth. It's the value of their portfolio. So if there's a discontinuity, it could be up or it could be down, somebody's got a windfall, right? Either a windfall profit or windfall loss. So if you're an option trader at a bank selling an option, and you sell it, and when you sold it, you made an approximation that the volatility is 20%. Okay? Never mind how you came up with that number. Maybe you did historical data, whatever. You sell the option for $10. A moment later, you realize actually volatility is 30%. Maybe you change your mind, maybe some news comes out. This could happen 6 months down the line, right? You still, once you sell it, you've sold it right till the expiry. Volatility goes up to 30% at some point. And I mentioned there'll be this jump somewhere. Now, who absorbs that? Can you go back to the client and say, I sold you this option 3 months ago at $10. I made a mistake. There's a problem in my spreadsheet. I assume 20%, should be 30. I should have sold it for $2. Can you pay me back the extra 2? Okay, that's not going to happen, right? You need to get it right on day one. And if you don't get it right, who takes the loss? You take the loss, right? Kind of similar to what we talked about with correlation, right? You make an assumption at the beginning, you say things look good, they're kind of decorrelated. If there's a panic in the market, all correlations go to 1, guess what? You're holding the wrong end of the stick. Okay, too bad. Okay. This is the important one. Okay, so we've done everything for call options. Now you can go back, and probably worth doing, reason it for put options, or you could use this relationship. Okay, I'd expect you to be able to derive that. Okay, you don't have to memorize it. You can actually derive it. And if you have C minus P is S minus K e to the minus RT, then what can you say about, I know, delta? We know that. We've got a diagram for it. If I just do it mathematically, what do I get there? It's just 1, yeah? Minus 0. So once you've got the delta of a call option, you've got the delta of the put. Just take the curve, add 1, easy. Okay? Same for all the Greeks. What if you want to take the gamma? What do? Take the derivative again. D squared C minus D squared P, 0. Turns out the gamma of a call and a put are the same. Okay? By the way, this is, does Black-Scholes tell us this? No, right? DC and by DS can happen to come from Black-Scholes. The fact that they're the same for a call and a put is a completely model-independent result. The fact that delta of a call and delta of a put are related that way is completely independent of Black-Scholes. Any model should satisfy that restriction, okay? Because this is a modeling independent result. You could do it for theta, same thing, you'll get something else on the side, but you get the idea, right? There are relationships that you can use. If you do the hard work for a call, that's it. You've got all the work for the put for free. Okay? Okay, so let's do a case study. Digital options. I hope this really just solidifies it in your mind. Okay, so let's do a digital call option or a binary option. I can't remember which one I used, but they're the same. European digital call option. We want to plot the delta, the vega, theta, the whole thing. Okay? Without any maths. Let's just do it. Thought process. So where do we start? Let's start off with the payoff. What's the digital call option? Do you remember? Yeah, so VT. If I use the indicator function, which I hope you're all comfortable with, that is just okay. That's the payoff. Okay, what about the price? The orange line that I had previously. Okay, without looking at it in a formula, can we figure out where on this chart it should sit? Where do you think it should sit? Well, let's try to restrict some regions. Can it ever be negative? Okay, can the price ever be negative? What if it was negative? What's the implication? Yeah, if something is negative, it means somebody pays you to take it. I'd be happy for someone to pay me to take this structure, which may pay me again later on. Right? Worst case scenario is you expire out of the money, you don't get anything back. So the price can never be negative. What about, so this region off bounds? Nothing happening there. What about more than one? Can the price ever be more than one? What if it was more than one? Sell the option. Put the money in the bank. What's the worst case scenario? You pay out $1, right? You keep the difference. So it can't be more than one. Okay, so this region is all out. So maybe it looks something like an S. Something like that. If I call that V of t, this is S. Okay, now that we've got V, everything else is easy, right? It's just think about the curve, think about the derivative, what does it look like? So what's the first derivative? What's delta? What do you think delta was? This looks very similar to a graph we've already seen, right? And if you're from machine learning, that's basically the sigmoid function. Okay, what's the derivative of the sigmoid type function? Or arctan, if you prefer. So delta, well, it's 0 there. It's flat here too, right? So it's 0 there. And it's always positive. It's going up, and then it kind of comes down. So delta would look something like that. Agreed? Okay. What about gamma? Gamma is just the derivative of the gray line. But what does that look like? Zero? Yeah, flat on the top there, or nearabouts. So 0 on the left, 0 at k, 0 in the long run. Positive here, negative there. Okay, so it looks probably something like that. Here's a case where gamma can be positive or negative, depending on where you are. Remember, for the put option, for the call option, we said gamma is always positive. Okay, here it's positive or negative, depending on what side of the strike you are. Okay, so that's gamma. What's the last one? Theta. Okay, so what do you think about theta? So what is theta? Well, that's the value. And what do we know about the value? As you get towards expiry, the value has to converge to the payoff. Okay, so what's it doing up here? If you're on this side, as you get closer and closer to expiry, V is pushing up. Okay? And as you're on this side, as you get closer and closer to expiry, V is coming down. So V is, or theta, basically looks the opposite to gamma. Okay, something like that. Okay, you've seen it here graphically. But remember I mentioned earlier that there's this opposite relationship between gamma and theta, because when one explodes, the other one has to explode in the other direction to kind of offset. That's exactly what you're seeing here. Okay, so the pricing formula bakes that in. And remember, theta goes to 0 at the ends because, well, for the same reasons they went to 0 in the case of a call. When you're so far out of the money, you don't care about 1 day, right? It just doesn't change things. Same, if you're deep in the money, you don't care about 1 day passing. Okay, your payoff's guaranteed. Make sense? So this is the type of reasoning you should be able to do on an exam. Okay, you can draw payoff diagrams without doing any maths. Just reasoning in terms of the payoff, what happens to the value of the derivative with time, with S. And notice, we've only ever spoken in 2 dimensions, T and S, right? Those are the 2 variables. Right. Any questions on that? No? Okay, I think I want to go on to the next topic, which is really introduce. This is kind of building up to the demo. Okay, I'm going to try to show you, demonstrate to you that Black-Scholes works. You've seen the maths, you've seen the economics, you've seen the assumptions, you've heard and maybe thought about this idea of replication, hedging, self-financing portfolios. It's all going to come together today. Okay? We're going to demonstrate numerically that somehow it just works. Okay? The maths does actually do what it's saying it'll do. But to do that, we need to understand a little bit about the business model. Right? Now we're talking about the business model of an investment bank. Right? It's like any other business. Okay? How does a business make money? It sells a product at a profit. That's all it is. I don't care what your business is. It could be a furniture shop. Okay? Maybe you make tables, you figure out how much wood costs, glue, all the raw materials, the machinery, your time. You figure out it costs you $80 to make. You sell it for $100. That's your business. Okay? The investment banks are no different. It happens that their product is a financial product. It's a derivative, some call option or some other derivative. So the client buys the product and they pay for it up front. Okay? The bank is trying to lock in a profit. That's all it is. They're taking something that costs them $10 to put together and they sell it for more than 10. Right? That's all they're trying to do, really. That's the V0. V0 is the Black-Scholes price. Okay? Which might be, I don't know, I'm making up numbers, $10. Let's say S0 is 100, K is 100, T is 1 year, for example. Okay? And Black-Scholes, we put all the numbers in, says the price is $10. So the client buys this option from us at $10. That's what's going on this side. And the client just sits on it. Right? They come back in a year. And in a year, who knows what could happen? Maybe the stock price goes up to 200. And they're feeling very good with themselves because they bought this thing for $10, it's now worth 90. And they expect the bank to pay them that 90. Okay? The bank has sold the option. You're now on the hook to make the payoff, whatever it is. It might be zero, right? But you can't sit on the $10. If you sit on the $10, you're opening yourself up to the possibility that things change. Okay? So what the bank does on this side is set up this replicating portfolio, this hedging portfolio. And the idea is that this is where the science comes in, right? They will manage this portfolio so precisely that at expiry, CT will equal to VT. Okay? Or minus. Forget about the sign, right? But they will manage that portfolio so carefully because nothing's changing on this side. V0 comes in on day one, see you in a year. In a year, what's the value of the payoff? All the magic happens here because the bank is now in the business of managing this portfolio and making sure that it ends up knocking out what they would owe the client, whatever it is. That's the science. Okay? This portfolio is not arbitrary. The trader doesn't decide that they think this is going to happen or something else might happen. It's science. The formulas tell you what to do. Right? So do you agree that if the bank can do all this, they've extracted themselves out of the risk? Okay? They don't care. Assume for the moment this works magically. They take $10. That $10, by the way, maybe the arrow that's missing, is used to set up this portfolio right at the beginning. Okay? So do you agree that if they can do all this, they've extracted themselves out of the risk? Which means that if the value of the derivative, according to the model, is $10, but they sell it to the client for $20, they've made a $10 profit. Okay? That's the idea. That's the model. That's the banking model. It's completely about taking yourself out of risk, not about taking on risk. Okay? And the demo that I'm going to go through now is basically what happens on this side. It's called delta hedging, replication, all that stuff. Any questions on this? This is key, right? You need to see this. This is the big picture. Everything after this is really the detail as to what's going on the left. Okay, so this is what we're going to do. We're going to assume, we're going to take on the role of an option trader at a bank. Okay? We're the option trader. Client comes along, buys the option from us at a price that we give them. Okay? So we're the bank. We're going to assume we have access to a bank account that pays R% continuously compounded. Okay? Not too much of a stretch, right? You've got access to a bank account. We will assume that all of the Black-Scholes assumption apply. That means stocks actually do behave log normally. All right? We're going to make that assumption. We're going to assume that we have no cash to start off with. Okay? The bank never puts their own money on the line. They're not taking any risks, so they should not have to put any money on the line. Any cash they need comes from the bank, which is a loan. Any excess cash they have, they put into the loan. Okay, so they draw in and out of this loan, this money market account, as and when they need. They never use their own money. Okay, it's a closed system. So you sold the call option, and we're going to assume it's a call option, and we hedge it precisely as the science instructs us to, right? And it is science. Just follow them blind. Follow the algorithm, follow the formulas without thinking. And this is the kind of a pseudo algorithm. Okay, so at time 0, we sell the derivative for V0, V0 comes in, right? We create this replicating portfolio, which we called C. But if you remember, that replicating portfolio is basically some units of stock, which is the Black-Scholes delta. I think we called it delta before. Maybe I shouldn't have changed the notation, but whatever. Okay, delta 0. The science tells us that we need to hold delta units of the stock. We've got some cash coming in. If the cash that comes in is enough to hold, to go out and buy that stock, all well and good. Okay? Go out, buy the stock, anything left over, put in a bank. If it's not enough, you borrow the difference from the bank. Right? So you need to buy delta units of the stock. The science, Black-Scholes, tells you how much. B0 is your initial bank balance. And now what we're going to do is keep track of the value of C and check that at the end, C at time Tn is equal to V at time Tn. Tn is the expiry. So what happens? We're going to do a Monte Carlo simulation. Okay, so I'm going to simulate a path of S, which you can all do. You've done Monte Carlo simulations, I think problem 6 for a stock. Okay, you use the Euler discretization, which is at the top, which is just to say that S at some time I plus 1 is wherever it was at time I, plus some drift, plus sigma S Wt, which is Brownian motion, right? Brownian motion is just a Gaussian random variable, which you can also simulate. Note, I'm using mu here. Okay, I'm using mu. I'm simulating what might happen in the real world. Okay, at each time step, so I'm going to do this daily. I'm going to assume I'm an option trader. I come in every morning. I need to rebalance my hedge. Look at what happened overnight. Take some action. And the action is that I know how much cash I have in the bank. I know how much the model is telling me I need to hold in stock. Okay, because dV by ds changes from one day to the next. It's a formula. We have the formula. The inputs to the formula change. So you know you have to update your stock holding from whatever it was yesterday to today. Maybe you need to buy a little bit more. Okay, that's delta hedging. That's what we mean by delta hedging. You need to update the cash in the bank because two things happen. You went home yesterday, you had some cash in the bank. You come in this morning, that has accrued some interest, but you've had to rebalance your stock holding okay, which is this. The formula tells you this might be positive or negative. Let's say it's positive. It means you need to buy a bit more of stock. You need to buy it at the new price. Right? You need to buy it at the live price. So you come in the morning, you figure out you need to buy a little bit more stock. You look at your Bloomberg terminal, you call up your brokers, they quote you a price, you buy the stock. If you need to borrow, get the cash from the bank. Okay, so that's why your bank balance changes every day. Okay, some of it is because interest accrues, some of it is because you've either borrowed or put back in. That's what we mean by the self-financing strategy. Okay, closed system. Money goes in the bank or into stock. That's it. None of it goes in your pocket, none of it comes out of your pocket. And you just repeat this right until the option expiry. Now, what could happen at option expiry? There are really two outcomes. Either the option expires in the money or out of the money. Okay? Now remember, you sold this option to the client. So at expiry, assuming you're in this world, the client's going to come to you asking to buy the stock. Okay, this is the scenario where S goes up to 200 and K was at 100. Okay? Now remember, you have this self-financing strategy going where you're holding delta units of the stock. What you need to hope for or make sure is that at that point, in that scenario, you're holding 1 unit of stock ready to give to the client. Okay, because they're going to come asking for it. And you hope it better be the case that your bank account has minus K in there, because the client's going to pay you K for the underlying stock, right, from the call option. If that's the case, you're completely squared. You've got a stock, you give it to the client, they pay you the strike, you pay back the bank, you're done. Okay? That's the top case. That's the scenario you want. You want to somehow end up in that situation. Well, if the stock price is below K, then you better not be holding any stock, right? You don't want it. You're only holding it in case the client would come and exercise the option. So in this scenario, you hope delta 0, and you hope your bank account 0. Okay? You hope that there's nothing left in the bank account. In that case, there's nothing to do. You're done. Okay? So it feels a little bit like magic, that somehow it all works out. Okay. Can people see that? All right, I've made this available so you can download this from Canvas. But everything that I'm doing on this one sheet is basically what I've just described. Okay? This is a simulation. If I press F9, it's Excel. You all have access to Excel, right? Okay. It's easier to do than on a Python script because everything's just in one place and you can see it. But basically, if every time I press F9, this sheet recalculates and I'm looking at a different path. Okay, so here I'm just indexing from 0 to 100. This is a 95 strike option, call option. Stock price is at 100 today. The expiry is in 3 months, so 0.25. And then I have some volatility. All I'm doing here, first column is indexing. This is time ticking forward. So each row, imagine, is a new day. You come in, something changes. Here I've simulated the stock price. Okay, and you can all do that already. You can simulate the stock price if you've generated random numbers. This column generates random numbers. Okay? And think about, take a look at it when you have a chance and figure out what kind of random number generator is it using. Because you've seen two. You've seen inverting the cumulative distribution function. You've seen acceptance rejection. Try to figure out which one it is. So that blue line there is nothing more than this column here. It tells you how S moves, how S is evolving with time. You know, we're kind of simulating the future. Okay? Down here is this is the price. Okay, I don't need a simulation. When I hit F9, that number doesn't change. That's just the Black-Scholes price. I've taken the inputs, put it into Black-Scholes formula, happens to be 8.534. Okay, that's the price of the option. What is important is how that price comes into play. So remember I said that that price should be enough for you to set up your portfolio on day one. The science is telling us that we need to hold 0.717 units of stock. Okay, that's the delta. So we go out, we buy the stock, we offset it against the price, the cash that's come in the door. We've got to buy the stock at 100. Okay, and you can figure out that on that day, your bank balance is minus 63. Okay, that's just where it worked out. It means you've taken a loan. Okay, you've got negative cash in the bank, which means you've drawn out of the bank. Now the rest is all just the algorithm I've described. Okay, next day, you've got some cash which is accrued interest. You figure out how much you need to rebalance. So this is telling you on this path, on day 2, you need 0.74. On day 1, you had 0.71. Now you need 0.74 units of stock. And it costs you that much to go out and buy the difference at that price. Okay? And that's it. You just follow it down. All the lines here are the same. You get to the end. That's the magic number. That's how much money is left in the bank. That's how much stock you're holding. Okay, so let's take that example. Stock price goes down. It's out of the money. That's the case where the client isn't going to call you back. You're never going to hear from them because there's nothing to exercise. And in that scenario, you've got zero, pretty much zero, 0.091. And you've got 0 units of stock. Okay? This residual, if you follow the formula, it's just basically what are you left with at the end, right? How much stock versus cash. Okay? Because if you're left with some stock, if you're magically left with some stock, you can sell it, right? And just liquidate your position, and that brings some cash in. So the residual is just how much residual cash you've got at the end. And you see it's quite close to 0. Okay? Somehow, in all of this, we started off with a price of 8.534. We've set up this portfolio. We've done our delta hedging. And we've ended up with nothing. Okay? Let's try a different path. It's always the same. It changes slightly, right? But it's pretty close to 0. Compared to 8.5, that residual is a pretty small number. Here's a path where the option expires in the money. Okay? It goes up to 110. In this scenario, you've got 1 unit of stock ready to give away. And you've got minus 95 in the bank. So your residual is still pretty small, 0. Okay? So it just works. Right? We've just done nothing more than follow the science, simulate it in time. Okay, what could happen? And by the way, we're not saying, this is not really a Monte Carlo, right? Monte Carlo is you run 10,000 paths, you take an average. We're not saying that, sometimes you're up, sometimes you're down, works sometimes, doesn't work sometime, but on average you're okay. That's not what we're saying. We're saying it works on every single path. Okay, no matter what happens, market goes up, down, sideways, you're going to end up with no residual. Which means that if you sold this option, I don't know if this will work, for not going to work. Plus. For $10 more than what it's worth. Is that right? Have I done this right? have I done? That's the price. Okay, if I've sold it for $10 more than what it's worth, look at my residual. It's always around 10. Okay? That's the model. That's all you're trying to do. Lock in that $10 and make sure. You see, it's no good saying that it's worth 8.54 today. I'm going to sell it for 18. I've made $10. You've only really made $10 if you get to the end and you still have that $10 in your account. Okay, that's the difference. Right? And that's basically the banking model. Get out of the risk. You don't want the risk. You're working very hard, doing very sophisticated science to get out of the risk and protect that initial margin, the original $10 that you sold it for. Okay? So the skill of a trader is all about what's going on down here. And if they do their job correctly, it means that this profit was real. Now, what could go wrong? How could this go wrong? Remember I said that we're picking a value of volatility and we're holding it constant. Okay. What would happen if you price this option? Okay. Comes up to 8.54. On day 2, you realize actually volatility is not 25%. I think the volatility is more like 50. Right? I got something wrong. You sold for $8.5 something. If I change that to 50, something that is actually worth $13. You've undersold. Okay? Because you're now going to go ahead, do your hedging, and at the end you're going to end up with some residual balance. Actually, what I've done here. Okay, everything's updated to a world of 50%. But you see what's happening, right? It was 8.54. That's all you've got. If you need an extra $5, where does that come from? The bank's P&L, right? So it's a loss. In the same way, if you simulate this forward with time, and this is a bit more advanced, but say halfway through, that's when the volatility changes. That's where you'll experience a jump. Okay? And it gets even more complicated because often you don't know what the volatility is. Here we're working in a world where we know the volatility is 50, we know it's going to change to something else. What if you price the option with 30% volatility? And you hedged it with 30% volatility all the way. But unknown to you, the market actually behaved like it had 50% volatility. Okay, that's an even more advanced question. How does that manifest itself? Well, it manifests itself in this residual. Okay, at the end, you're going to end up with a short position. Or it could be positive. Okay, maybe you sell the option assuming 50% volatility. Turns out volatility is only 10. Right? In that case, you make the money. Any questions on that? Any questions on any of today's material? Previous lectures? We have a couple of more topics to go through, but let's, if there are no questions, let's break there for 10 minutes. We'll come back at 5 past. Related to
The simulation, right?
the simulation, okay?
The part you have already covered.
This one here?
Yes.
Okay.
Why does MC1 do this? Like, if they're not gaining anything
Oh, what do you mean they're not gaining anything?
in terms of like whatever they get like as money, they're offsetting it as.
No, no, no. But okay, so that's the business model. Any business model, like furniture shop. If it costs you $80 to make a table, you don't sell it for 80. You sell it for 100.
Oh, so like they're getting a price, but the price they're quoting to the client is fixed.
Exactly. It's always higher, right? And it's that difference that's the profit. But it's only true profit if you follow the science. Okay? It's exactly the same. It's like, say you sell your table, you're a furniture shop, you sell the table for $80 because you've worked out cost of wood, glue, etc. And then you realize you made a mistake. You had a decimal point wrong somewhere. The table actually cost you 110 to make, but you sold it for 100. That's a problem, right? That's kind of what we're saying here. If you don't follow the science, if you get something wrong, if some of the assumptions aren't valid, you're going to end up selling this product at a value that's too low. And you won't find out about it. That's the thing. You won't find out about it until the end, when you look at your bank balance and you realize actually you owe money. Okay?
Yeah, another question regarding this RA. I think that I was just operating on a model just some time ago and found that when the interest rate goes up, the price of the option goes up. What is that?
When the interest rate goes up, the price of the option goes up.
Yeah.
I don't know if that's true. What we're going to see here is that if you change the interest rate, it's like changing volatility. You're changing something outside of the model. Okay? You're going to end up in a situation not too dissimilar to what was just raised, but you're going to end up selling something which you should have sold at 13, but you ended up selling it at, say, 10 or 15. You see what I mean? So interest rate and volatility should not change. In this model, they should not change. They should stay whatever you assume them to be at the beginning. If you change them some way through the exercise, you broke the model. You broke something. You can fix them day one at the beginning, and that's it. Then this would all work. If you change it, you're looking at a different problem. Okay? Imagine you can have two of these sheets. One for client 1, who bought the option with 1 year expiry. Another sheet for client 2, who bought it 3 years expiry. Different stocks, different volatilities. That's okay. But they are two different models. What you can't do is take this first model, lay out your parameters, start doing all this, day 1, day 2, day 3, all the way day to 100, but on day 50 decide, you know what, I want to change all that. Can't do that. For the simple reason that you couldn't change the strike price of the option halfway through the life of the option. It doesn't make sense. What? You change, sorry? Right, but I'm saying, when do you change them? No, at the beginning is okay. At the beginning is okay, before you start. Because remember, the beginning is, if you think about it from what's happening day to day, the beginning, when you're changing the parameter, is exactly what you're doing as a trader when the client calls up and says, I'm interested in buying the option. Okay? You're making a price. Making a price means changing those parameters, getting them right. Once you settle on the price, that's it. You can't change the parameters after that. Right? You have to hold to those parameters right up until the end. Okay, so just think about it a little bit. Think about what's happening day to day. This is, as I mentioned, this is supposed to represent a simulation as to what actually happens. Right? We're assuming we know what would happen from one day to the next. Any more? Okay, So now you've seen Black-Scholes. You've seen Black-Scholes, you've seen derivation, you've seen the model. You can derive the pricing formula. You've seen the hedging, right? Now we're going to start this week, next week, talking about what can go wrong with Black-Scholes. What if some of the assumptions we made are not valid? Okay, so this is prep work really for next week, where we will challenge the log normal assumption. Okay, but first we need to introduce some concepts, and the first one is the implied volatility, which is the most important it's the most important parameter that option traders talk about. Okay, they're always talking about what is the implied volatility? What is the implied volatility? What's happening to implied volatility? So what is it? And I'll explain it mathematically first, and then we'll talk about the economics. Mathematically, it's nothing more than the value of volatility that you need to inject into your Black-Scholes pricing formula to extract a price. Okay? So what's happening? The market in vanilla calls and puts is very, very liquid. Okay? If you need to know a price, you can call up JP Morgan, Bank of America, whoever, they'll give you a price. Right? One thing you know is where the price is. You can figure that out. Call up a few brokers, take an average, you've got a price. The implied volatility, okay, so that's the price. The implied volatility is what level of sigma, and I'm going to call it sigma star to now differentiate it from what we previously called sigma. Okay, it's what value, sigma star, that you need to put into the formula to retrieve the price. Okay? If you know the price, you can work out sigma star. If you know sigma star, you'll be able to get back the same price. So all we're doing is just changing the language that we're talking in. So option traders don't talk in terms of dollar price of an option. They talk about the implied volatility. Okay? They sell an option at 20% implied volatility. What does that mean? It means take 20%, put it in this formula, whatever that price is, that's what they've sold it at in dollar terms. Right? All cash flows get settled in dollar terms. Now the problem is to do this inversion is a little bit complicated. Okay? You've seen the formula. It's okay. Here we go. It's there. You need to invert C, right? You need to figure out what value of sigma gives you some target value of C. So it's not easy to do it. You have to do it numerically. Okay? That's the numerical part of the exercise. And if you plot C against sigma, okay, so all I've done here, this looks like the payoff. It's not. Okay? It looks very similar, but it's not. You've got volatility on this axis. And you've got premium or price on that axis. And all I'm doing is you can do this in a Python script. You plot how C changes with volatility, and you get that graph. Okay? Sloping upwards. More volatility, more price. Makes sense, right? More volatility, distribution gets wider, higher potential payoff. And the exercise, now you've called up your brokers, they've given you a price. And you need to extract the implied volatility, right? You need to go backwards. Easy to go this way. Just follow the formula. Not so easy to go that way, right? You need to invert it numerically. And in this course, we'll only consider two. There are much more sophisticated algorithms, but these two are more than good enough for us. Okay? So if you come from an engineering, applied maths background, you would have seen something called the bisection root finding algorithm. Okay? All it is you write a function like that, and the goal is to solve f of sigma star equals 0. What is sigma star? Okay? And this is the pseudo code, the pseudo algorithm. So this is the kind of thing you should be able to do for an exam. Okay? If you're asked to derive or write down an algorithm that it can extract implied volatility, etc., that's it. And what is it doing? If you had a function which did something like that, you try to bracket the solution. Okay? You need to start your algorithm with some sigma L and sigma H. So sigma L is here, sigma H is here. You need to initialize the problem correctly. You pick sigma M, which might end up being somewhere here. You figure out, do you need to drill in further on the left side, right side, and you keep going. Okay, that's the algorithm until some termination conditions. So with a pseudo algorithm, I won't be looking at kind of you writing it in terms of proper syntax, just the logic. When does it terminate? What are the terminating criteria? How do you initialize it? Which I haven't done here, right? I haven't checked that sigma L and sigma H are actually wide enough, but that's one thing you need to do. Okay, so you need to be able to write this down just in terms of steps that can be translated and transcribed into code. Okay? Okay, that's bisection. The other one is Newton-Raphson. It's very, very popular. Have you all seen it? How many people have seen Newton-Raphson? Okay. So it's one of the standard algorithms. It converges much faster than bisection. But effectively what you're doing is, as always, Taylor expansion. Okay? Just write down the Taylor expansion around a point xi. Okay, they're higher order terms, but Newton-Raphson ignores them. And the idea is that you start off on some xi, and the question is, well, which direction do you go in? Okay? And you want to go in the direction such that this becomes 0. Okay, so if this is 0, just rearrange, you come up with that formula there. Okay? Called it k here, but sigma k plus 1, the next step is where you were minus this adjustment. Okay? For those of you from a machine learning background, you would have seen steepest descent, right? This is smart steepest descent. Why is it smart? Why is this smarter than just regular steepest descent? What else, if you're running steepest descent, what else do you need to specify? You need to, exactly, the step size, right? That's the learning rate, the tuning parameter, and you have to tune that parameter, right? So you have to pick it. There's nothing to pick here. Here, Newton-Raphson looks at the rate of change of the function and implies what a sensible learning rate is. Okay, so you don't have to do it. So this is kind of machine learning steepest descent more advanced because it's telling you how much to go. But again, it's very similar in terms of a pseudo algorithm. You need to be able to derive that, talk about the terminating conditions, which is you meet some, get to within some tolerance. That's the market price, which you get from the market, and it's just an inversion. Okay. Now the reason I'm introducing this is because next week, when we start talking about volatility skew and volatility smiles, everything is in the language of implied volatility. Okay? So we're going to stop talking about option prices and we're going to start switching to option implied volatility. But they're the same. You can go from one to the other. It's a simple mapping or a numerical inversion. But the point is it's a one-to-one mapping. Okay? Any questions, either bisection or Newton-Raphson? All right, last topic for today. And as I mentioned, this is not examinable material. Okay? This is more, it will come up next week. We will use it next week. But again, we're going to use it in the context of a model called the local volatility model, which isn't used all that often. So from that perspective as well, I don't want to spend too much time on techniques that are kind of very quickly becoming outdated. But it's such a great result, and you've done so much work to get this far that this is just an additional step, right? To get a more thorough understanding of stochastic processes. Okay, so say, this is the long and short of it. Say you have a stochastic process X. And it's got a drift, and this is Brownian motion. So we're still working with Brownian motion. But the drift is now any generic function A and B. Could be a function of x itself, so it could be stochastic. The only restriction is that they're well-behaved, smooth functions, right? No crazy jumps, nothing like that. So it's the most generic stochastic differential equation that can describe a process. Okay? And this originally came up in statistical mechanics, right? When physicists are trying to model particles and where they might go from one time to the next. And they're random, right? Because they're moving so fast. But whatever it is, you can come up with some functional form for these drifts and volatility. Okay? You're trying to understand where the particle will be in the future. Okay, you know where it is now. But there's randomness in the system and it's going to float around. So you know that, actually before that, because it's random, you want to be able to understand what the system could look at in the future. And understand in this case means what is the value of x. And if we're talking about a particle in one dimension, it's the position of the particle. Okay? Or if you want to think of it, what is the price of the stock? But I think in this case it's more useful to think physically in terms of a particle. Okay? Somewhere on the line. Now you don't know where it's going to be because it's random. That's the whole point. And next best thing you can do is understand the probability density function of where it might be. Okay? If you don't know where something's going to be for sure, next best thing is, well, assign the probability function. And that's what I'm calling P. P of function of time and x. What is the probability that the particle is at a position x at some time t? Right? And we know where the particle is now. So P at time 0 is known. Okay, so I'm going to introduce this thing called a Dirac delta function, which is nothing more than a function which is 0 everywhere, except at some point x0, at which point the height is 1 over epsilon, and the width is epsilon. That's all it is. It's like it's 0 everywhere except at this one special point. And the reason it's defined this way is because if you take the product, it's always 1. Okay, so it really represents a probability density. So Dirac delta at x0 is just that chart there, that graph there. And it tells you it's basically a probability density function which is all centered on one point, which is another way of saying is we know where the particle is. Right? Now the question is, you start off there, what is that going to look like at some future point? Okay? What is it going to look at some future point? Maybe a few minutes later, and that's going to be your variable. All right, so now the long and short of it is, I don't want to go through all the maths in detail. The derivation is in the notes. Okay? It's very messy. It's not advanced mathematics, but it is just calculus intensive. But guess what? We're going to use Taylor again, right? It's one of the most used techniques in this course. But if you expand f, and let's choose f to be this special function. It doesn't need to be. Okay? The result is independent of this special restriction, but it turns out it's a useful one to make. But if you do a Taylor expansion, okay, f of at some later time t, starting there, plus all of these terms, which are just the Taylor expansion multiplied by the coefficients. There's another term here, which is the Ito Brownian motion term, which disappears because you take expectation. Right? These two disappear because of the assumption here. And you end up with that expression. Okay? The integral of an expectation, because you can switch the order of integrals. The expectation is nothing more than an integration. So you switch the order. And then you rewrite it in terms of that. So I've replaced expectation with an explicit integration, right? It's an integration over the probability density function. And you just follow the maths. These double integrals turns out to be quite easy to solve. You can use the integration by parts. Okay, it's all in the notes. You do a bit of calculus, this is the result. Okay? And this is the result which tells you you've got a partial differential equation in P. All right? And that's why it's a powerful result, because this process is perfectly general. It can be any process you want, as long as you specify A and B neatly. You specify them, you can immediately assign a probability density function to your process. Particle, stock price, whatever. Okay? It just has to satisfy this partial differential equation, which is actually, by the way, not too difficult from what we've seen, right? Time derivative, spatial derivative, second spatial derivative. We've seen that already. It's simpler in some sense than the Black-Scholes formula. Okay? You've got the b squared inside and the a inside. Okay, so you need to deal with that, but essentially less terms. Okay, you solve this, you've got your function p, and you can predict a probability distribution for where your process ends up, given where it started and given some completely general dynamics. Okay? What if I set A and B to be constants? What do you end up with? What if A and B are constants? What is that process? Gaussian, right? If A and B are constant, that's just a Gaussian process. So guess what P is going to turn out to be? The PDF of a Gaussian, right? Which you know. And if A and B are some constants times X, that's the log normal distribution, which you also know, right? So you get, under those two special conditions, you drop out to the probability density functions we've already seen. But if you want to make them more complicated, now you don't believe in the Gaussian or the log normal anymore, something much, much more complicated, plug it in, solve the PD, and you've got a much more advanced process, right? That's not the direction we're going to head in next week, although I kind of hinted to it, but that's the idea. That's the forward Kolmogorov equation. It's just, I hope you've seen all the maths, right? It's not much of a step to come up with this quite remarkable result. Okay? Numerically difficult to solve, but hey, any process, you've got some chance of solving the PDF. Right, any questions? Sure.
Investment banks, when they price options, do they assume log normal, or do they have their own custom models?
They have their own custom models, and all the models out there are modifications on Black-Scholes. Okay, so next week we're going to talk about that. We're going to look at some of the models that, what we're going to show next week is that the implied volatility tells you a lot about how deficient Black-Scholes is. So the first thing you want to do is take the information that the implied volatility is giving you and sort of put it into your model. Okay? Because one thing about everything we're doing here in this course, as a quant, you believe the market is correct. The market prices are the true prices. Right? That's the assumption we're making. So if we see a price in the market, our model needs to be able to respect that price. It's very different to a hedge fund who look at a price in the market and they challenge it. Okay? It's the exact opposite. They look at a price, they don't believe in it, they try to challenge it. They put on a position that will profit if it turns out that they're correct. With a bank, you're trying to make sure you're pricing things consistently with the market. See, with a hedge fund, if you figured out that there's something wrong with the price, you won't know till right at the end. Okay? With a bank, you at least want to price it correctly, consistently with everything else you're seeing. If that's wrong, well, guess what? Everything's wrong, right? At least your portfolio is consistent. Anything else? So remember, I think next week's lecture is cancelled. So we'll be back in 2 weeks. And there will be a replacement lecture Saturday the 8th, I think it is. Okay? So in terms of parting comments, remember, work through the derivations. Okay, try to price the options yourself. Make sure you understand the techniques. Kirsanov theorem is important. Doing the expectations, the integrals, all important. The payoff diagrams, being able to go from a payoff diagram to the Greeks payoff diagram, that's quite important. Put-call parity. So you've seen a lot of quite important concepts today. Okay, so I guess I give you back 30 minutes. Thank you.